Amortized, simple, revolving, compounding interest. What's the difference? Does interest interest you? Interest is an interesting problem or thing, whatever. But since there are four different types of interest as applied to financing, and they have very different effects on how much interest you will pay, I suggest you pay close attention to this, what I hope to be an interesting discussion about interest. First, we'll tackle amortized interest. Amortized interest is the most complex and one of the most expensive versions of interest. It's actually fairly simple mechanically, but it's just a little difficult to explain so that the results are clearly understood. I think the biggest problem with explaining interest on financing is that the interest rates do not correspond with the actual interest paid on the principal. You'll see what I mean in a minute or so. First, with some interest types, they can be applied to a loan and to a savings account. This is not the case with amortized interest. It is only applied to loans. The most common loan types that have amortized interest applied are mortgage and auto loans. Some other personal loans will also carry amortized interest, but mortgage and auto loans are the most common. Amortized interest is applied at the contracted rate to the total balance of the loan at the beginning of each pay period. Typically, the interest rate is expressed as APR or annual percentage rate. Most likely, payments will be scheduled on a monthly basis. So the annual interest rate will be calculated for the year, then divided by 12 to find the amount of interest applied for the month or pay period. But the pay period is just the 1 month. So the interest on the balance of the principal is again calculated and the monthly portion applied to the next payment due. So looking at a mortgage loan in the amount of $165,000 at 4.5% APR, the interest rate for the year would be $7,425. Divided by 12 months equals $618.75. Using a mortgage calculator, we find that a monthly mortgage payment for this loan, $165,000, will be $836.03 per month. Applying $618.75 to the interest charge, that only pays down the principal of the loan by $217.28. So next month, the interest charged will be $617.94. And again, only $218.10 will be applied to the principal. At that rate, paying $836.03 a month for a year, you will pay a total of $10,032.36 on the loan, but the principal only gets reduced by $2,661.82. So by the end of 30 years, the average length of a mortgage, you will have paid $300,970.80 for that $165,000 loan. That's $135,970.80 in interest, or 82.41% of the principal. Simple interest. It's really quite, simple. Simple interest can be applied to loans and savings, but it works differently in both cases. On a loan, the interest rate is calculated on the principal, then multiplied by the total years of the loan. So a loan of $10,000 at 4.5% APR, simple interest over 5 years would have a total interest of $2,250. That's a simple calculation of the principal. That is $10,000 times the interest rate of 4.5% times 5 years. Simple. But simple interest as paid to savings accounts is only applied to the original principal. So if you deposited $10,000 in a savings account, paying 4.5% simple interest, in 5 years, you would earn the same $2,250 as you would pay for a 5-year loan of the same amount and at the same interest rate. If you let the total amount in the savings account, if you left the total amount in the savings account, it would be now $12,250, but you would still only earn $450 for the year because the interest is only paid on the original deposit amount. Basically, the interest paid to your account never earns any interest. Still, currently an interest rate of 4.5% simple interest is a heck of a good deal. The highest available in any bank savings account at the moment and hard to find. By comparison, my favorite life insurance company is paying 6% compounding APR. I'll get to compounding interest shortly, but first let's talk about revolving interest. This one is only available for credit lines. Nobody pays revolving interest on savings. Revolving interest is the best type of interest for a loan or line of credit. Revolving interest is also expressed as an APR, but is calculated on the total credit balance at the beginning of each pay period. And the amount applied to the credit loan is prorated to the month. So an APR of 15%, which is a typical credit card right now, is calculated at 1.25% per month. If you have a balance of $5,000 on your credit card or line of credit, for the current pay period, your revolving interest charge will be $62.50. Likely on a $5,000 balance, your minimum payment will be around $200 a month. So if you don't add any more charges, your next month balance will be $4,862.50. And interest will be at 1.25%, $60.78. You pay your $200 minimum payment, and your balance goes down to $4,733.28, and so forth. Obviously, the lower you can keep the balance on your credit lines, the more you will save on interest charges. And there's a strategy we teach that is very effective at doing this. It's called sweep strategy. And we have another video that explains that. Now, for my favorite type of interest, compounding interest. Now, this is the type of interest you want to earn on your money. Simply put, compounding interest pays interest on your deposited money and interest paid to your account. So if you deposit $10,000 into an account that pays 4.5% APR compounding interest, you will earn $450 the first year. If you don't add any more to your savings account, the next year you will earn not $450, but $470.25. So the interest earns interest too. In most cases, the compounding is done annually, but there are some instances where compounding is done more frequently, such as quarterly or even monthly. Usually, with the more frequent compounding, there will be a correspondingly lower compounding interest rate. But the point is, with compounding interest, the total balance of your savings account is earning the full compounding interest rate. So if you add $1,000 to your savings, The whole $11,450 will earn that 4.5%, and that'll give you $515.25 in interest, which will then earn more interest for you, compounding. Now, see, interest can be very interesting. Now, let me just throw this in because it's really pretty cool. The rule of 72. The rule of 72 tells you how long it'll take for your money to double at the compounding interest rate you are earning, no matter how much money we're talking about. So let's go with the $10,000 initial deposit, not adding anything to it except the interest, which, as we've been using, the 4.5% rate, compounding. What you do is you divide 72 by the compounding interest rate, 4.5%, and that gives you 16. That means it'll take 16 years at 4.5% compounding interest for your $10,000 to become $20,000 without you adding anything to it. Now, if you're earning 6%, like my clients' accounts are right now, it'll take only 12 years for your money to double. 4 years faster than at 4.5%. Who knew interest was so interesting? And if you found this to be helpful, please hit the like button for this video and subscribe to this channel. Also, please post your questions and comments here. You have questions, we have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below here. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is also below. And if you'd like to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. Aloha and mahalo for watching.